So there's been a lot in the news lately about alternative investments like private equity, and private credit in particular. Normally, these are investments that have been reserved for pension funds, institutions, accredited investors, so pretty wealthy individuals. But the news lately has been about them becoming more widely available to regular folks. In fact, BlackRock's CEO, Larry Fink, was saying that he thinks that the future of balanced investing, rather than 60-40 between stocks and bonds, might look something more like 50-30-20, with the 20 being private assets. And he's not alone. We've seen other major asset managers like KKR, Apollo, the Vanguard, and Wellington, Blackstone, beginning to offer private investments in different wrappers that make them more accessible, like exchange traded funds or in target date funds. So we thought maybe it would be helpful to discuss, like, what are we even talking about when we're talking about private equity or private credit, to help clients understand maybe where these things come into a diversified portfolio.
So private equity, if we could throw a blanket over the whole term, what we're really talking about is ownership of companies that are not publicly traded on some kind of stock exchange. And the way this historically works is an investment firm, when they're getting into private equity, would raise money from institutions, from pension plans, for example. And as Brendan said, accredited, super high net worth investors. And they use this money that they've raised to go out and acquire companies, to take them private. And then ultimately what they want to do after managing it for a period of time, 3 years, 5 years, maybe longer, the exit plan typically is to take that company public again, or to sell it to someone else down the road.
Yeah, I mean, in the simplest terms, we're talking about, like you said, there's the public markets, which is, the stock exchanges that we're used to following every day, that we all have access to. And then any other business is going to be a privately held business. And whether it's held by individuals or by a company who is an asset manager in the space, like, we're talking about private businesses. And I guess, we've seen a lot of companies, rather than IPO, become public to get their funding, like they may have past decades, take this route of getting private funding instead, as a way to raise capital for their business.
Yeah.
It's just an alternative way for businesses to get the money that they need to scale and grow when they have a good idea that's profitable.
It's certainly not considered a passive investment. A lot of times these private equity firms will take an active role in the managing of these companies. So, what they want to do is make improvements so that these companies are profitable or more profitable over the period of time that they own it. They really want to improve the overall appearance of the company and their profitability so that they can sell it at a future date down the road. It becomes a good investment for them. So,
yeah. And when we're talking about private credit, it's basically the same thing. We're talking about, non-bank lenders,
right.
kind of like non-traditional lending to businesses that need funding.
Yeah.
And that would differ from a company like Apple offering bonds, or the United States Treasury offering bonds, in
Right.
the sense that these are going to be, I guess, by their nature, probably for companies that, for whatever reason, are not capable of going the route of getting traditional loans, from lenders, or at least not to the extent that they want, or there could be some other reason why they're seeking this. But it's ways for these companies to capitalize themselves,
Sure.
that differ from the more traditional routes. And so that's what, when we're talking about these private investments, whether it's the equity or the debt, like, these are the two sides of kind of that private marketplace that differ from the more public, readily investable areas of the market.
Yeah, they're not bank loans, and they're not all the time, but sometimes they would be considered not investment grade. It's not, if you owned private credit, there's no readily available market, and I think we'll touch on that in a moment as well. So, the opportunity as an investor, opportunity for higher yields, but you may be taking on significantly more risk with a private credit, private lending type of deal.
Yeah, I mean, I guess that probably brings us to maybe the next logical stop in this conversation, which is why would people want to have exposure to private equity or to private credits? Like, what are the good reasons for it? And what you just said is kind of, it's almost like a pro and a con in the sense that, like, if these are riskier loans, or if like a private company, if you've bought their equity, like by the nature of it, you would assume perhaps it's riskier than buying like a blue chip stock. You would hope that more risk equals more return. And so the idea is that some of these institutions, endowment funds, have like famously done very well investing in the private markets because it's higher risk, higher reward is the idea. So maybe that's like the top reason that you would want to do this.
Sure. On the private equity side, if you have one winner out of 10, that can outweigh all the other losses that you took investing in some of these seed companies or startups or projects that you're looking to turn around. You only need one winner, and that will knock out all the other losers. On the flip side of that, on the private credit or private lending side, before private equity really took off in the 60s, 70s, and through the 80s, when a publicly traded company ran into trouble and the stock went to zero and it looked like bankruptcy was looming, that's when a lot of people realized that the bondholders really own the company, because once the stockholders got wiped out, the private lenders, or in this case, the private lenders, would wind up owning the whole shebang.
Yeah. So, I mean, I think what we're talking about there is kind of like the opportunity for better returns.
Sure.
I guess in addition to that, just general diversification benefits. I think I'm pro that most people would say in favor of private investments is that prices tend to be more stable, but I think that that's kind of misleading is probably the way that I would put it, even though that's maybe not fair to people who want to sell these investments. It's just that they don't price every day because they're private. Like when we have publicly traded companies, they're pricing every day on the exchange. So if you want to sell them, you know exactly what they're worth at that moment in time, and you can weigh whether or not that's what you actually want to do. And with private investments,
there's really no way of knowing.
There's no way of knowing until you want to go sell the asset and get a bid. So like they're illiquid, and that's part of the reason why you can get higher returns in them is the illiquidity, or at least that's the idea. And again, that factors into the risk. But I guess some would say that non-correlation or diversification benefits could come in the sense that like the prices don't seem to move as frequently as your public market investments do. But I kind of have a bit of an issue with folks who would say that that's a pro, but that's normally one of the pros that you would hear from. I guess we're talking about these companies and their CEOs talking about bringing private investments to a broader base of investors, and that's usually one of the things that they'll say is that diversification benefits are a reason. Like we're all missing out on this, and that the very rich have been investing this way for decades without us, and now's our chance to strike while the iron's hot.
Right. So this also tips over, and we should probably do a separate video on this, but it's for some of the same reasons we talk about with high yield bonds. When we talk about high yield bonds as part of a client's portfolio, we really look at that as it is part of the income sleeve, but it really behaves like equity. It behaves like stocks. And so, one of the shortcuts I used to say a lot was, if you want to invest in junk bonds or high yield bonds, you should just own the stocks, own stocks instead, because you're taking the same amount of risk for it. So
that's our take on the situation. Tons of people allocate to these other asset classes or more broadly to fixed income than we might. But I think what you're going to get from private credit exposure is going to look like junk bonds on steroids is the idea. Like these are riskier loans that are like part of the reason you would do it is because of the higher yield that you're promised to get. And I think inherent in that has to be the understanding that you're accepting more risk as a result of it.
So we're kind of tap dancing around the third point, but let's deal with this head on. What are some of the reservations we may have about, just if we can just summarize all of the the things that we think about and talk about here in the office when we're dealing or talking about private equity and private credit?
Well, I think illiquidity and high fees are like the top things that you need to be at least aware of if you're going to allocate to these asset classes.
Yeah.
And those both in tandem tend to be things that we philosophically aren't big fans of when it comes to investing. But I mean, if you're aware of them, at least you can decide whether or not it's a big enough deterrent for you.
Yeah,
It just seems like the higher fees, you have the guarantee of a higher fee for the possibility of outperformance.
Yeah.
And some pensions, endowments, individual investors have very famously, as I've said, done really well in these asset classes. I guess for me, it's a matter of trying to understand why at this point in time they're coming to us, using
why
us
now? Yeah.
well, to mean all of us, like in the sense of like more average investors, like why are they offering this supposedly great opportunity to everybody now? And it kind of seems like maybe they've tapped out their market for these private investments, and now they need more people to come in and like buy their bags from them. And I don't know if I want to be that person necessarily. Like you need to vet the individual private opportunity that is in front of you and understand it well enough to say whether it's a good one or a bad one. Because like all active investments, like I think there are bound to be some winners, but there are bound to be mathematically just way more losers.
Yeah.
And if you don't know how to pick the winners ahead of time, then I'm not sure that it's worth allocating to in a way that's going to be costly from a fee perspective.
So 2 thoughts on that. And the guys have heard me say this around the office too many times now. I like to say if it were that good of a deal, they'd keep it for themselves.
Probably, I think.
Probably. But I'll also speculate that, in reading some of the articles, the recent articles in the Wall Street Journal and in Bloomberg and a few other places, one of the things that has come up is when companies were taken private or acquired before they even went public, the initial plan or the original plan was, hey, we're going to work with the management of this company for the next 3, 4, 5 years, and then take them public or sell them somewhere else. The back end of these transactions has not been happening. So they haven't been able to move a lot of their merchandise in the sense that the IPO market has been really spotty for the last few years. There just haven't been a lot of successful initial public offerings. There haven't really been a great deal of stock activity when it's come to that. That's slowed down a lot of their pipeline in the sense that, hey, we'd like to invest in more of these projects, but our capital's tied up in some of these longer projects. Mm-hmm. So just speculating, that may be a reason.
Yeah. I think I'm also just very wary of like even the way that these assets are titled, like by calling them private, I feel like you like activate some sort of like thing in our lizard brains where it's like, oh, I must need this opportunity because it's exclusive. Like the exclusivity of it attracts people and their money like some sort of bug zapper. And I just feel like if you're interested in this asset class because it seems exclusive, I'm even more reluctant now that they're like using phrases like democratizing to suggest like why, like almost as if they're bringing these things to the public as like a sort of like Robin Hood, like act of good, like you've been missing out on this,
and I duty to do
and
this.
I want to be the one to bring it to you because it's so wonderful. And I don't know, like obviously there are going to continue to be good opportunities in the space, but it's
going to be a lot of blowups too.
Yeah, and I don't know how to say like in the idea that some of these are going to be packaged up into target date funds. Like instead of like what Larry Fink was saying, like instead of getting like, a 60-40 fund with stock and bond exposure one day, the default option in a 401k plan could then be, a target date fund that has 10 or 20% or something, some percentage of the portfolio in private investments, which like has already been happening, but they're talking about doing it in a bigger way. And so like the idea that that's going to happen and somebody isn't even going to necessarily like be aware of it or be able to vet the type of private equity or private credit exposure that they're getting under the hood, like I'm not willing to believe that that is going to be that that they're going to get exposure to one of the good ones, I guess is my problem. How do we know that?
Yeah. I think, a lot of people were surprised when, or they may not even be aware today in 2025, that mutual funds can have up to 15% of their capital invested in private equity. And it's amazing. Sometimes you look at the top 10 positions of a fund and you'll see, I'm going back now 10 years ago, an investment in Uber is the 7th or 8th largest position in a particular fund. How did that even happen? And
But
what are the deals that we didn't know about?
that's what I mean, though. I think that's the problem is like we only go back and look at, wow, look at this fund. It had exposure to Uber way early. And like, obviously that's been to their benefit since it's a publicly traded company now and it's been one of the winners. But as you described earlier, the kind of private equity mentality is like spray and pray.
Yeah.
And if one or two of them work and become 5 or 10% of the portfolio for an active manager, like great. But also there's been a ton that have fallen by the wayside that were total zeros.
Yeah.
And I don't know ahead of time that you can identify the fund who's going to be able to get these, get an allocation to the next Uber, right?
Yeah.
Like that's, if we knew that, then we would do far better things than just selecting the mutual fund that's going to get an allocation. Like we'd go and try to offer the company our money directly, I think.
Yeah. And I also think that, you talk about the term private, like in private equity or private credit being a little bit like a bug zapper. I love that line. But the other thing that I think about when I hear that term private is there's very little transparency. If you own an individual stock or an ETF or a mutual fund, you can look up, in the case of a fund, you can look up and see what their quarterly positions are. With an ETF, you can look up every single day and see what their positions are. And a publicly traded company has to report their earnings every 90 days. There's plenty of news and plenty of transparency going on. Not so with private equity deals.
Yeah, no. And for all of the extra cost involved for either the asset managers or the companies to report and kind of deal with like the regulation, red tape stuff. I mean, a lot of it is in the best interest of investors in terms of having this information. So maybe there's a little more trust that needs to be involved when you're allocating to a fund that's going to be selecting private companies. Like you're just going to have a lot less information. So the idea of like what I'm not even quite sure what the process would be to vet an active manager. Like, like if you're going to put money into Blackstone private equity fund, it's like what are you even hearing from the manager of that fund in terms of what their process is and how they allocate those funds and like what the criteria is in terms of what the exposure is going to look like. I mean, I'm sure you'll hear something from them, but I don't think that you're going to get assurances in the same way that you do allocating to, an index fund where you know based on the rules of the fund exactly what you're going to be getting.
Yeah. Yeah. Good point.
And it could be rewarding or it could be the opposite. And I don't know, I guess that's the point of the conversation today, is to just maybe think through all facets of that. It's not currently something that we have, I think we've stuck to the boring stocks, bond, cash portfolio. It doesn't mean we don't consider alternatives, and the alternatives bucket could mean stuff like we've talked about on podcast videos before, like gold, like commodities, like private equity, private credit. I mean, these are all things that we have to think through for our clients, but we've kind of stuck to that tried and true stocks, bond, cash. And I think that's served folks well, at least to this point. I mean, this conversation is the sort of stuff that's going on behind the scenes, though, as we build client portfolios, and we've got to stay on top of this stuff. So it's why we're thinking it through.
Yeah. And why we wanted to share it with you today. Mm-hmm. So thanks for tuning in.